There is a letter going out to homeowners right now offering $60,000 in cash. No monthly payments, no interest ever. What it actually costs works out to around 20% a year. And if your home falls in value by 50,000, you can still owe 97,000 on that 60. A federal court just ruled these contracts are what they always were, loans. Check this out.
A letter shows up in your mailbox, and it reads like a gift. $60,000 wired straight to your account. No monthly payment. No interest. Not now, not ever. You keep living in your house. You keep your name on the deed. There is nothing to pay back each month. For a lot of people staring at that envelope on the kitchen table, it sounds like the answer to a prayer. And here is what you need to hear before you sign it. The catch is not buried in fine print you can wave away. The catch is on page 14, and a federal appeals court just called part of that no interest promise deceptive. If you saw our video on how Wall Street quietly turned homeowners into renters, this is the next move in the same playbook, with one twist. This time they let you keep the keys. They just buy the part of your home that has not happened yet. Before I show you the math, let me be fair, because this pitch is landing for a reason. Americans are sitting on roughly $11 trillion of home equity, which is simply the part of your home you actually own, the market value minus what you still owe on the mortgage. Most of that money is locked up. Millions of homeowners have a mortgage under 4% that they will never give up, because refinancing today means trading it for something closer to 6.5 or 7. A home equity line of credit, what the industry calls a HELOC, means taking on a second monthly payment your budget may not have room for. And if you are retired or self-employed or living on gig income, plenty of banks simply say no. No income check, bad credit, no problem, say the letters. Where a bank sees a risk, these companies see an opening. So a lump sum with nothing due every month feels like the only door that is open. And for some people in a genuine bind, it can even be a useful tool. I am not here to tell you it is evil. I am here to tell you what it costs. Because if your gut is whispering that no payment, no interest money is too good to be true, the company's own pricing sheet agrees with your gut. Here is how these deals actually work. They are called home equity investments or shared appreciation agreements. The first thing they will tell you is that this is not a loan. On paper, you are selling them a share of what your house will be worth in the future. That framing is the whole game, so hold on to it. The second piece is the multiplier. 12% of your home's value handed to you in cash does not cost you 12% of the future. It costs you a multiple of it, up to 1 8/10 times that slice. So 12% in cash today can mean they own about 21.5% of whatever your home becomes. The third piece is a discount on your starting number. So if some contracts, their share begins growing from a value below what your home is worth right now, which means they are already ahead before your house gains a single dollar. And the fourth piece is the one that bites hardest. You do not pay this back a little each month. You owe it all at once, in one lump sum, the day you sell, refinance, or reach the end of the term. One balloon payment. No installments and no easing into it. Let me put real numbers on it as an example using the company's own disclosed terms. Say you take $60,000 against a $500,000 home. That is 12% of the value. So at their multiplier, they own about 21.5% of the future. Your house grows a steady 4% a year for 10 years. Now it is worth about $740,000. Their share of that is roughly $160,000. You receive 60. You hand back 160. That is about 2.5 times the cash, which works out to something near 10% a year, and that is the good scenario. Selling year 3 instead, and the percentage math runs so high that you slam into the company's own ceiling, a cap they wrote at 18.5% compounded monthly, which comes out close to 20% a year in real terms. Credit cards would blush at that. Now the ugly scenario. Say your home falls to $450,000. You can still owe around $97,000 on the 60 you took, paying far more than you received while your house lost value. The companies will point out that their own published examples show effective rates as low as 0 to 13%, and that is true, but those assume you hold the full term in a slow, steady market. Early exits in hot markets are where the cap does the damage. Now here is the pattern you will never unsee once you have seen it. The oldest trick in finance is to rename a loan so it escapes the laws that govern loans. Call it an investment, call it a purchase, call it shared appreciation, and suddenly the rules about disclosing interest do not seem to apply, except the courts have started reading the substance instead of the label. In August of 2025, a federal appeals court, the Ninth Circuit, ruled in a case called Olson versus Unison that one of these contracts was in fact credit, that the no-interest claim was deceptive, and it treated the deal as a reverse mortgage under state law.
Hey everyone, real quick, just to jump in, I built a course that teaches everyone everything they need to know about mortgage all in one program. It's called the Mortgage Master Course. Links down below. I want people so prepared that they walk into a loan broker, saving money, making money, and being able to not be fooled by people that are making money off of your decisions, even if you don't know what's going on. Links down below to that. Now let's get back to the video.
The Consumer Financial Protection Bureau, the federal consumer finance watchdog, had already put out a report flagging exactly these contracts. And a chunk of the complaints it logged described them in a single word: predatory. That same agency has filed arguments that these products are credit and belong under the Truth in Lending Act, the law that forces lenders to show you the real cost of borrowing. Connecticut now requires these companies to hand you cost disclosures spelled out over 5, 10, 15, and 30 years. A bill to regulate them nationally landed in the Senate in June. Illinois and Maine already have rules, and North Carolina and Pennsylvania are moving. And the Attorney General of Massachusetts has sued HomeTap, alleging the product is really an illegal high-interest loan. To be fair to the companies, they dispute all of this. They argue it is a genuine sale of future value, not a loan, and that they share your downside if the home falls. That argument is exactly what the courts are now testing. So where does the $60,000 in your mailbox actually come from? This is the part that tells you what you really are in this deal. These contracts get bundled together by the thousands and sold to bond investors as a package. HomeTap raised $278 million that way in 2024 and $300 million more in 2025. Unlock has done it. Point, working with a firm called Redwood Trust, has done it. Rating agencies on Wall Street now call home equity investments an asset class to watch. Read that slowly. Your home's future value is being packaged up and sold to investors as something to earn a return on. You are not just the customer, you are the collateral, and you are the yield. And this is scaling right now for one reason: that lock-in effect. All those homeowners frozen in place by a mortgage they will never willingly give up has trapped a historic amount of equity behind a door a normal refinance can no longer open. That is precisely the person these letters are hunting for: equity rich, cash squeezed, and out of easy options. Every one of those bundled bond deals raises fresh money, and fresh money means more envelopes in more mailboxes. Here is the part that actually protects you, and it is not fear. It is knowing your real options cold before anyone puts a multiplier on your house. There are 4 other doors, and you should be able to price each one in your sleep: a HELOC, a second mortgage, a cash-out refinance, or simply selling. And you can run the math on any equity offer yourself in about a minute. Take the cash advance, divide it by your home's value, multiply by their multiplier, and multiply that by what you honestly think the house will be worth when you exit. That number is what you will hand back. Then ask them one question, in writing: what is the most I could ever owe you, in dollars, in your worst case for me? If they will not put that number on paper, that is your answer. Read all the way to page 14. And watch the regulators, because those state bills and that federal case are moving fast. And they are moving because thousands of people signed these before anyone did the math for them. So picture 2 people, same letter, same kitchen table. One of them reads the front page, sees the words "no payments and no interest," and signs that afternoon. The other one reads to page 14, runs the numbers, and quietly puts the pen down. 10 years from now, only one of them still owns their whole house. The letter was never a gift. It was an invoice with the due date left blank. If the money's free, you're the collateral. Economic Ninja is out.